All right, Rohit, we are live. Thanks for jumping on today. I'm really excited to chat with you on Around the Coin.
Thanks for having me. Great to be here.
Yeah. You run a really exciting company, Stilt. You guys have raised a lot of money, something in the order of, I see 340 million. Is that about right? Yeah.
Yeah, we are a lending, or we also do loans. And most of that money is for lending. So it's not coming to companies' bank accounts. Or it's not for operations. It's not going to pay my salary. We have raised, I think, about 375 total, and 350 of that is for lending, and an additional 25 is for equity for operations.
Yeah. And let's just give a little description of maybe I'll ask it to you this way. When you started the company, what problem did you intend to solve?
Yeah, when we started the company, we were trying to build a new credit score for international students. That's the problem that we faced ourselves, that we tried to solve. When I moved to the US, I was sleeping on people's couches because I could not rent an apartment, and I was in New York. I went to Columbia University, and no landlord was giving us an apartment because I didn't have a credit score, a credit history, or a cosigner in the US. Just some of the problems that all international students and immigrants face, or almost all. And after I graduated from Columbia, a few years later, I was working in the Bay Area and working on side projects just for myself to become a better coder. I was working as a data scientist, and I was trying to learn coding plus doing side projects, something that can potentially be valuable. And I used my previous experience and knowledge of credit risk and the problem that we faced around better access to credit for international students. So we worked on a project to build a new credit score for them. And that evolved into Stilt, where instead of selling our credit scores, we actually started lending money ourselves. And we started the company with our own savings. So the initial loans were actually given out of my co-founder and my savings.
Wow. Yeah. Back then, how did you target people in contrast to, say, today? How did you, maybe target's not the right word. How do you filter, or the mechanism for determining who and how much people are worthy of getting?
Yeah, so it wasn't an exact science because we were doing something new, but I have a background in credit risk and analytics, and I worked for 2 years at a consulting company that built risk models for banks, particularly for credit card portfolios. So I come with that background, and then I layer on this additional knowledge of the immigrant population. So when you go to a bank, everything actually starts with credit score. Like their policy just starts with credit score. That's why everywhere, if you apply for a credit card or a loan, auto loan, mortgage, anything else, everything is the bands are based on credit scores, right? So that's how they viewed it. And when we started, we said we are going to look at factors other than the credit score. So we looked at bank account statements, we looked at education, i.e. university major, potential job opportunities, those kinds of things to determine whether we'll give someone a loan or not, and what will be the amount and the interest rate and stuff like that. And it just came out of our heads. Essentially, there was not a lot of science to it. Based on my knowledge and understanding of the market, said this person seems to have this kind of risk. This is the amount we can offer them. This is what they can, I think, what they deserve to pay. And we, as always, with every company, we charged too less in the early days. And the clients came to us from all sorts of places, but Columbia University international graduate students were the few customers that we gave loans to. Exactly the people who we were a few years ago. And those people took loans primarily to pay for rental deposits, buy a car, build a new life, so on and so forth.
Yeah, it would seem to me when you're very targeted, when you have a really targeted audience on lending, you can be really accurate. You can be really profitable, right? You don't have a lot of losses because you know why people are taking out the loans. You know that these are people with full intention to pay back, as opposed to if you're just like broad strokes saying anybody apply, and then there's a top of the funnel that just uses credit score or some other blanket mechanism. It seems to me that, tell me if you agree with this, that there's a underappreciation for the psychology of why people want money, and an over assessment of the quantitative values. And that just may be due to drives and efficiency, but relying on numbers either in bank accounts or on credit scores, it's a nice way to scale, but it misses a huge part of factoring in people's likelihood of returning that capital. Is that true? Or
Yeah, I phrase it as acquisition is more important in lending than underwriting. And if you can acquire the right customers in the right way, you actually don't have to underwrite that well. You can suck at underwriting if you're really good at acquisition. And that's what a lot of lending is about, is acquiring the right type of customer at the right cost. And then you can sort of get away even with simplistic underwriting. There is a reason, one of the reasons banks don't super innovate on underwriting is regulatory, but B, they also acquire customers in certain ways. Like many banks will not give you an unsecured loan if you haven't been their customer. So their acquisition channel is basically someone having a banking relationship with them for a long time, right? So that's extremely important in lending. And I think most new founders or most fintech founders tend to appreciate the value of acquisition and tend to overestimate the value of underwriting. You can get the same, as an example, you can get the same customer from a Google search who's searching for a loan. And someone with the same quantitative profile can come to you from a friend's referral, and friend is your borrower. You will see better loan performance on referrals versus someone coming to you from Google search.
Oh yeah, I heard that. Actually, I heard an interesting anecdotal story on this that I forget what company it was, Kiva or Talal. One of these companies that makes microloans to people in Africa. The mechanism that they drive a big part of their decision from was they make you connect to your phone book. Like you download the app, you connect, and then they look how many people. I think it's specifically the negative attribution. So they say if anybody in your phone book, if you have anybody in your phone book that has been blacklisted, like taking a loan out and not paid it back or whatever, then you're immediately declined.
Tala, I think, is the company you're referring to. Tala and then Branch. Like these are two big companies.
Okay, yeah.
Started using. So the Tala was started by Shivani Siroya, who did some research on lending in Africa, and Branch was started by Matt Flannery, I think, who started Kiva in Africa. And Kiva was a nonprofit, and Branch is his version of like a venture-backed lending company. And yes, they do use data in people's phones to underwrite them, and they found interesting things around like consistency of calling close friends, consistency of like people calling you, so on and so forth, as predictive indicators of whether you will pay back your loan or not. I'm not particularly sure whether they said if someone blacklisted is on your phone, we are not going to lend to you. But that may have been an indicator because it's an indication of a fraud ring. Possibly, yeah. Like if someone blacklisted, if you have like all your contacts are blacklisted by the company, then possibly not good. Not good. So that's possible.
Yeah. Do you know what the overall rate is of immigrants to the U.S. who maybe come here specifically for school that are taking out loans and don't pay back? I imagine that's very, very low, but do you have a rough idea as the number?
So the data, because these immigrants are not eligible for any type of federal funding, and the data is not tracked or holistically not tracked in the US, you can only find data if they have taken loans from banks in their home countries, and you go and look at this particular segment, performance of this particular segment in those banks' reports. And there's a bank in India called HDFC, and it gives out loans through an entity called Credila for international students, and those are student loans. And the performance on those loans across, I think, $300 million plus worth of disbursements was a loss of 0.02% type of thing. And to put that in perspective, the average interest rate was 12%, and then the default rate was 0.02%. To put that in perspective, for the average rate of 12% unsecured student loan in the U.S., default rates are at least 6 to 7%. I mean, student loans are generally cheaper in the U.S. because they are federally subsidized, and you keep hearing about, people in debt and not able to pay back. I think 25% of student borrowers or borrowers of student loans are in delinquency for federal student loans. And in India, or for Indian population, again, it's like a subset, and they are highly qualified. They go for higher quality universities for STEM degrees, so on and so forth. So there is all that bias in there. But given all of that, for $300 million worth of disbursements, the default rate on a 12% yielding portfolio is 0.02%. This type of portfolio is unheard of in the U.S. across any type of asset class. Even mortgages have higher default rates in the U.S. that are collateralized by someone's home, but not for international students, at least coming from India.
Wow. So was that the statistic that made you convinced you were going to start a company in the space? Because when you tell me that, I'm like, well, what's the point of underwriting? Don't even waste your time. Just raise as much money as you can and give it away. Yeah.
I learned about that statistics way after I started the company, as I was trying to prove to other investors with my limited data that this population is actually low risk. Right? What prompted me to start the company, what made me start the company, was a problem that we faced ourselves that we felt need to be solved for other people like ourselves. And just to clarify, we started with international students as our primary population, but now we serve all immigrants. So it's not just students, it's also working class visa holders, it's also DACA holders, refugees, asylum applicants, anyone who is legally in the U.S., irrespective of their status. We offer unsecured personal loans to them. And the thesis is still similar, is that immigrants are inherently a lower risk and higher quality population than comparable U.S. population, because it's a self-selected group of people who have to jump through so many hoops to build a better life for themselves, or who are trying to build a better life for themselves, and they are culturally more attuned to repaying their debt. Right? They're culturally averse to debt.
Do you think the long-term implications of the decision the federal government makes to give out nearly zero interest-free loans to students will be a positive or negative thing on American students who take those loans?
The answer to that question is above my pay grade, but I'll still try. There are both positives and negatives, like knowing that you can actually get an education that you want without worrying about access to money gives you a certain amount of confidence to go and try to do whatever you want to do, right? Juxtaposing it to the Indian education or Indian student loan setup, you have to literally mortgage your house or your parents' house, your grandparents' house to get money to pay for education. And I can tell you, like, there's 10x, 50x more talent in India that doesn't have access to funding. And if they got access to funding, they'll just do crazy things. By crazy, I mean crazy good things for the world, moving to the US, and they'll do really, really well. And that's kind of a thing that we have seen. Asian Americans have the highest average income of any US household, or any US group in, at least for the past 10, 20 years. So that's one piece, is that it gives the confidence to students that they can pursue what they want to pursue. The flip side of it is people are not pursuing the right things. They are pursuing things that don't result in income for them in the future, and a lot of them end up dropping out, but the student loan doesn't go away. Universities taking advantage of these students by selling them on programs, on dreams that don't result in any income, and you end up with like $200,000 student loans with expected income of $50,000 a year, and then it takes you like decades to pay it back, right? So that's kind of the negative, and it's always difficult to determine which side should someone lean on. Obviously, US needs to pay, or universities need to pay for high quality research, high quality curriculum development, high quality teachers, all of that stuff. So US gets to stay ahead of the other countries in terms of producing remarkable individuals who actually go on to do big things, right? And I guess they are, as a result of that, and to do that, they are also like getting paid for all these students who end up not being employable compared to the cost that they paid for the education. So it's a difficult choice. Eventually, I think government, instead of just saying blanket, give loans to anyone who wants to go to university, they need to put more pressure on universities to build programs, and they should only allow funding for programs that where students are actually employable. I mean, sometimes some students like going to trade school are more employable than students going for, I don't know, some sort of history or literature degree. Not that it's something that they shouldn't study, but paying $200,000 to study literature when the jobs are not available and you won't be employable is at least not like a reasonable financial decision.
Yeah, and I think that the two factors that come to mind layered on top of your point are if you're paying $200,000, you're going after a literature degree, you're going up against people who have access to all the same knowledge for free. So if you were to just watch, any of the open courseware content that Harvard, Yale, MIT, Princeton, they all put out all their own content, and then of course YouTube. So you just have just an avalanche of free content and education out there. So if you're pursuing those domains, you're going up against those people. And then you're also going up against people who are outside the country that have a much lower cost of living if you're moving to an expensive city like New York or SF to study. But I do think that the education system in the US is and was very inflated. There's probably a lot of colleges, tier 3 liberal arts, that just shouldn't exist in the first place. Given that the reason they do exist is because there was so much money given to people that wanted to go to college, period, regardless of what they're going for or without any long-term perspective, that it's like, well, why not open up a school and charge people money if people have free money given to them by the government? So yeah, I think it's kind of it's unfortunate, but it seems like it's like a political mistake to some degree to not have any checks and balances there. So it seems like people are aware of that. And I've heard people talk about loan forgiveness or at least changing the loan program.
Yeah. I mean, who knows what will come out of it. And it's always a debate that can be had. But the important thing is, like, if you are a STEM major, and I think we looked at this data internally or through US federal loan statistics, if you are a STEM major and STEM or like doing a major that is highly employable and you finish your degree, it's highly, highly unlikely that you'll end up defaulting on your loan. So for example, if you're going for med school, and irrespective of your loan being a $250,000 loan, if you actually graduate and get a job as a doctor, if you graduate, you are likely to get a job as a doctor, you're likely to pay back your loan. But if you're doing any of the other non-employable majors and you don't graduate, then your chances of repaying whatever small dollar loan are actually slim. So not all student loans are $250,000 loans. A lot of student loans are just $10,000 loans, but people are not even able to make enough money to pay back those $10,000 because interest is accrued and they are just not in a position to pay that back. Yeah. Anyways, I mean, the student loan was just like a small thing. Like, our main focus now at Stilt is more around, building technology to enable other fintech startups to launch their own products, including a bunch of crypto companies who may want to launch a loan product or a credit product, but they are not able to do so because the regulations are so complex and the infrastructure requirements are so high. And whatever we learned by doing at Stilt, we have just abstracted away and API-fied our years of brain damage for other companies, so they don't have to go through the same brain damage.
Yeah, thank you. We all appreciate that. I know how busy it is often running startups to have a meeting and say, hey, we want to launch another startup or another product in Onbo. What was the decision-making process there? Was it clear that this was something worthy of engineering and marketing and business resources, or how did you decide to launch Onbo, and what is Onbo?
Yeah, so Onbo is a product by Stilt, and it's a set of APIs that companies can use to enable credit products or use to offer credit products. What we have done is we have taken a lot of hard work out of compliance, state licenses, loan management systems, payments, credit reporting, and underwriting, and built APIs on top of that. So anyone can plug into our infrastructure that offers all of these various components that are needed to build a lending company. The only thing you need to bring is debt capital, essentially, and you can, stay away from or like do a lot less on everything else, and launch a product within a few weeks. Now, coming to Onbo, like Onbo wasn't even on the horizon before we launched it. And sometimes we think about, my co-founder and I, sometimes we go back and we're like, okay, when did we actually decide that we launch Onbo? And we can't figure out that moment where we decided this. I think it just happened in phases, in a way where we were thinking of like a new product to work on, and we were going through and we are a B2C company essentially, right? Like, and we were working on, like, we are thinking of new products to launch for our customers, for immigrants. And on the side, we had always been reached out, or we were always approached by founders who are trying to launch fintech products. And I do a little bit of Substack writing and sometimes post things on Twitter, which founders find helpful. And they were asking us, how should they launch their credit products? How should they, like, what are the elements that they need to build their credit product? And I was just helping I've helped, I think, maybe 100 plus founders over time to do this. And the common theme across all of that was they just didn't know enough about this, or it just was taking a lot longer for them to actually do this because it's tricky and it's difficult. So the idea just for the new product was more organic in that sense, and like, okay, we can potentially productize our infrastructure so other founders can launch their products. And that's how it came about, but I don't remember the exact moment. I do know that at Money 2020, I was in October 2021, when I was at Money 2020, that's when we decided that we'll work on this, because I talked to a few founders with the focus of whether to pitch them a product like this. It wasn't called Onbo back then, and then understand what their response is. And I think I was fairly confident that I can sign a few deals as I talked to these founders that gave us the confidence to actually work on productizing our infrastructure. And then eventually it became Onbo.
And what was the pitch to them? What did you say to them that they said yes to?
That you don't have to spend years building lending infrastructure to start lending, to launch a lending product.
So these would be people who are interested they were already working on a lending product, and you had done all the legwork where they could just jump in and use APIs?
Yeah, you can. I'll give you a better, more real example. Let's say you're a crypto wallet, and now you have like $10,000 in your crypto wallet and distributed across Bitcoin, Solana, Ethereum. I don't know. I'm not as up to speed, but like you are just putting money there, and you don't want to take that money out to spend on something, and if you have a need. Now, crypto wallet, it's in their best interest to offer a line of credit or a loan against the Bitcoin in the wallet, right? And as of now, if the crypto wallet needs to start lending, they first have to acquire all the licenses. They have to build a compliance management system. They have to build a loan management system. They have to build payments. They have to build underwriting. They have to get debt capital. So they need to do so many things even before they can do their first loan. And with Onbo, we abstract away all of this. So it becomes the company, Onbo, and then behind Onbo is all of this infrastructure. So company just needs to interact with Onbo, and then company can interact with the customer, and Onbo just sits in between them. And they can just launch a lending product within 4 weeks, 8 weeks, depending on the stage of the company. And then, the product is live and company can start making money. And
that's so great. That's so great, considering how painfully difficult it is to get all the money transmitter licenses and go through all that back office work. Right. That's so. You have 2 different sites now. Onbo.com is an amazing domain, by the way. 4 letters. Did you guys pick the domain up before the name, or did you just have the domain, or did you buy the domain separately?
At the same time, like the availability or the potential purchase of the domain was a part of deciding a name. There were many names.
Where do you pick that up?
I'm sorry?
Where did you pick up onbo.com? Curious.
We bought it from someone who owned it. So we paid $75,000 for the domain. We initially bought onbo.co, and we're like, do we really need .com? And then at least at Stilt, like, because we also own stilt.com, right? So
it's a good one.
So we realized that if we get more credibility, and even if we get 1 or 2 more customers because of the .com throughout the lifetime of the company, it's worth paying for the .com. At least at Stilt, because it's a consumer company, you need more trust. And .co is actually a Colombia domain, right? Like it's commonly used in the US, but if you look at country domain, then it's .co is Colombia, and then people are like, oh, someone in Colombia is trying to get our information, and that's not good. So they may hesitate from actually using the product. And similar thing applied to similar thing applied to Onbo, where we wanted to give our clients the confidence that it's a legitimate product, legitimate company. It helps with, and then it also helps with SEO and marketing and so many other things. And whenever you hear a company's name, you actually just go to .com first. And we're like, okay, maybe we knew that we'll do some like out of home advertisement, and whenever people saw the name, they'd go to .com. But in our ads, we actually wrote onbo.com, not just Onbo, like onbo.com. So it's onbo.com is a thing. So people are going to Google and searching for onbo.com.
So I mean, it's great. I think if you're going to have a 4-letter domain, you might as well just swing for the fences and get the .com. It's like real estate, if you have it, people know you paid for it, and they're like, oh, it's just, I'm more likely to trust these people if it's not a cheap, $1,500, $50 domain. Which, I mean, pretty much every domain I bought is super cheap. So I like seeing real 4-letter domains out there. So of these 2, how do you split your time? I mean, is still the vast majority of your time and business revenue and focus, or is it shifting, or where is it today?
It's shifting. Stilt is the vast majority of revenue. I mean, we have done hundreds of millions of dollars in loans through Stilt, and it contributes 95% plus of our revenue even today. But Onbo is the up and coming product. The quality of revenue is different. The future potential of Onbo is way bigger compared to Stilt, because through Onbo, we are enabling every company to be a fintech company. And that is 100x, 1000x bigger opportunity rather than us going and acquiring all immigrants ourselves. So I am spending most of my time on Onbo, kind of like, making a new product popular, trying to make a new product successful. So going back to the roots of finding product market fit, talking a lot with customers, preparing sales materials, doing sales calls, working with lawyers. There's a lot of compliance work here, so on and so forth. All of that work is just going into making sure Onbo is seamless and frictionless for companies to use, and they can get up and running in a week. Sometimes my goal is to be self-serve, and it's super complex. But that's what I'm trying to do. Now.
Yeah, that's awesome. That's awesome. So Onbo could pass Stilt in revenue someday. It almost seems like you're building a product that's going to consume your own.
Right. So Onbo's first customer was Stilt. That's what we started doing when we started building the product. We tried to make Stilt a customer of Onbo, because it's the same infrastructure, right? Like the advantage with Onbo is also that it's battle tested. We've been doing lending for so many years. We have processed $4 billion worth of loan applications through the same infrastructure. We have disbursed hundreds of millions of dollars in loans. We have done millions of dollars of transactions, or millions of transactions in number through the same system. So it scales. It does really well. It has been tested across so many different unique edge cases that no other credit as a service or lending infrastructure company can claim.
When you say $4 billion in loan application dollars, and then you've issued hundreds of millions, does that mean the hundreds of millions is the actual percentage that was approved from the 4 billion in people applying?
Yes.
So is it true that you're turning down most applications?
Yes, that is correct. I mean, it's true for all lending companies. When you go out in the market and you say, our business is to give you money, you will get a lot of people who want money but not wanting to pay back. That's where like a lending business needs to have strong.
What about the number, the 0.02% of immigrants to the U.S. in education that don't pay back? If that's true, I would think that your acceptance rate would be somewhere in the order of like 99%. Is that where am I?
No, I think the way to think about that is, of the people who were given the loans, 0.02% of them defaulted. If you gave a loan to everyone, then that 0.02 may actually become 20, right? So it's the high quality underwriting that results in lower losses. You can't give, like, lending is a product. Lending is a business of saying no in a way. It doesn't sound that good, but eventually you will make money only on the people who you give money to and who pay you back. If you give money to everyone, majority of them are not going to pay you back. So you have to be selective in who you give money to. I'm sure if all of your friends ask you for money, you'll be like, you'll pick and choose and give money to a few who will pay back. Not everyone's going to pay back.
Is there not a rate risk factor that you can associate for each person? So if you think someone's unlikely to pay back, you just say, hey, your rate is way higher than people who are more likely. If that's true, why would someone even get declined at all? Wouldn't in theory there be an option for everyone? It's like, but the interest rate would be so bad that they'd be foolish to take it? Or
two ways to think about it. First is first important thing here is, as you are accepting higher risk individuals, you are kind of making the people who pay you back pay for the people who don't pay you back.
Right.
If I'm charging 10% to everyone, like people who paid back are actually taking the weight of people who are not paying back, right? Because there are some who are not paying back. That's one. The second assumption in that statement, in your statement of you can like risk rate everyone, is that you are able to risk rate everyone 100% correctly, right? But that's not the case. I can't really evaluate each individual with a true risk because of the variables that I can use to determine risk. What that means is US government has defined the areas, the parameters that you can use to determine someone's risk. and they are not like which prevent you from being super precise in underwriting. Otherwise, you are going to amplify disparities in social inequality. And someone who has not been able to get loans, get money before, someone who has not been able to get loans will actually be denied even more. Right. So US government, that's why it defines some parameters. So you are always imprecise in underwriting because of these regulations. And because you are imprecise, you are now then distributing the cost of the non-payers to the payers. And people who think that they are highly likely to pay back, or they are low credit risk, will go to someone else who's giving them a loan at a lower rate than us if we started approving everyone. Does it make sense? So we have to like balance these two things.
So by introducing these barriers, does the U.S. government decrease the total dollars that would have gone into the market from lenders? Would you agree with that statement? That if there were no laws preventing lenders from using every attribute possible, there would be more lending dollars total distributed lend?
There possibly will be more lending dollars distributed overall. Whether that makes economic sense, or whether that's good for the consumer and whether that makes economic sense, is a different story.
Do you feel like as a lender that the U.S. government properly calibrates the spectrum there of what's allowed and what's not allowed? Say, for instance, they ratchet it up and they say, well, you can't use age, you can't use eye color, you can't use skin color, you can't use location. The only thing you could use are these four things, right? It's like what time of day they wake up, what they have for breakfast. Like, if we limited it down, there's some point at which it's just, you can't, there's no lending going on because it's like you just don't have enough data. Do you feel like we're too far on one spectrum or the other, where there's just too much allowed and that accelerates the social inequities, or on the other end where there's just not nearly as much lending as that could happen?
I'd say US government regulation, it's difficult to keep up with innovation in technology. And that's where regulations are trying to catch up, but may not have caught up. And the way you define is like what is allowed, as an eye color, time you wake up, and a few other parameters. What the US government does is they say what you cannot use. So they define the things that you cannot use. You actually cannot use skin color. You actually cannot use ethnicity, national origin, gender, sexual orientation, zip code to a certain degree. Like if you go very deep in zip code, you actually know income levels, right? Like, so you can't use a deep level zip code. It has to be broad enough and representative, things like those. So US government prevents inequality through those. And it actually happened in mortgages through something called redlining, where people who either were of a certain color or belonged to a certain social group or something like that were not able to get mortgages. And it's an important factor in terms of home ownership in today's time. So government has defined a few things, but as technology moves forward, regulations are trying to catch up. And as an example, like there is no regulation that talks about bank transaction level data to be used or not used in underwriting. And because like bank transaction level data didn't exist before, only credit reports existed, right? So it's a new parameter that needs to be used then, or companies are using, and it's not defined in the regulations. And government just falls back to, okay, is it leading to discrimination or disparate impact? Discrimination is something that you do upfront. If I start giving loans only to Indian people, I'm clearly discriminating against everyone else, right? Or I make it a condition that you have to be from India to get a loan from us. That's discrimination. Disparate impact is actually more tricky to evaluate. And what it means is, even if you did not intend to discriminate, but discrimination ended up happening after the fact, you are still responsible for that negative impact. So you have to be careful that you don't lend in a way that results in disparate impact.
What is discrimination? How do you define that in this context?
So discriminating based on there are 7 factors that the government has defined.
Oh, okay.
National origin, ethnicity, gender, sexual orientation,
okay.
the 4 zip codes. So discrimination is no upfront at the time of approval, no discrimination based on these variables.
Okay. And even if a decision that you make as a lender has an impact on one of those variables, what that would really look like, I mean, I'm having a tough time understanding it, because every decision that a lender would make, it would always have a, it's like, well, we approved more women than men. Well, does that mean, I mean, even if we used, height, or we used income level, or we used anything that you could possibly use, you're never going to have an even distribution of all of those factors that you just listed.
Yeah, it's not about even distribution. It's about using parameters that lead to materially different results that are in favor of one particular group or disfavors one particular group. Now, as an example, like income is an allowed factor. But if you paint the US with like income levels, you will see different ethnicities have different income levels, right? But a lender can choose to say anyone below this income level will not be approved, right? But everyone above this income level needs to be approved, and that may look slightly different, but it's still a blunt enough variable that allows comprehensive approval rate. So if people from different ethnic groups, different nationalities are above that income level, they will continue to get loans. So it's not a black and white thing, and that's why it's difficult to implement and also prove. But every lender knows it in their bones that they cannot openly discriminate based on certain variables.
God, it's so tricky. I mean, it's fascinating, because it's in so many ways it's where the political ideology and the political regulatory laws that are passed, it's where it's where the rubber meets the road. It's like ultimately there's a gate switch, and it's like, do you have access to this capital? Yes or no, due to all the parameters that go into that decision. And I think I'm of the belief generally that that less government is better, and I'm also in favor of many different forms of government in different areas. Lending, I've never been able to come up with a clear understanding of what's really appropriate, or the feedback loops that go in order here. It's like, what I'm really hesitant of is subscribing to some being supportive of some regulatory decision or federal mandate or blocking that has negative repercussions. Like I think we were talking about earlier, but I think giving free money to people to go out and get educated actually has the negative effect that you want. Like it doesn't actually, it's counterintuitive. And I wonder if that's happening here as well. I don't know that to be true. It just seems like companies want to make money, and so they're going to use all the information possible. They want to lend money, right? Lenders desire to lend money. So they're looking for every possible person they could lend money to. And when a government blocks lenders from having access or using some detail about a person, it may not be bad, is my only point. That there may be negative unforeseen consequences of blocking data. And I don't know. I wonder if it's successful in its efforts, because it's one of these things that it's so important to every person when they go and apply for a loan, but it's hard to comment on it from a societal level or systemic level, because it's so cloaked behind the company's walls and their underwriting tables and everything else.
Yeah, not easy or simple or straightforward,
no,
or with one clear answer But maybe, who knows, crypto may solve this.
You think so? Yeah.
It's extremely difficult to imagine the future. Like, imagine going back to when crypto wasn't around, like when Bitcoin wasn't around. And if I were to ask you to predict the future, you would take all the information that you have at that point, and you'll just like extrapolate that information to or multiply it based on whatever you know at that time, and you'll like, this is what the future will look like. And it'll be very interesting if you go look at the 1950s, where they project futures in the 2000s, and you go to 2000s, project future in the 20s, 30s, whatever it may be. And it's extremely difficult to do that because you are not taking into account the innovation cycle that happens on a daily or on a frequent enough basis. Before crypto, people couldn't have predicted crypto. Right, like, and even after predicting crypto, people couldn't have predicted the impact of crypto. Before internet, people couldn't have predicted internet and couldn't take that into account into their calculations. So today, even with crypto being around and slowly becoming a part of slowly becoming a part of the internet economy, I don't think we completely fathom the second order, third order effects of the stuff. Like, nothing has an impact on a straight line basis as you assume it would. And we don't know how the next 5, 10, 15 years are going to look like.
Well, on that point, let me ask you to predict the future. What do you think the decentralized, I've thought about this, and I've asked a few different guests too, but I still think it's a fascinating idea. So credit unions in the current world that we have with TransUnion, Equifax, they're incredibly centralized. We've experienced the vulnerabilities of that with the hacks that happened a few years ago, like millions and hundreds of millions of people's personal data, security numbers were leaked. If you were to do it on blockchain, I haven't seen a project that's really taken off. But it seems like blockchain would be a perfect example of a place where you could have your own private key, manage all your own personal data, and then different APIs connect into that. So if I purchase things, I can record it on chain. I can gather together this like vault of personal credit that I can then use to apply on, plug it into lending services. Have you seen anything? And if not, do you think this is going to evolve in some form, or how do you see credit unions evolving on chain?
Just a quick thing there. Credit bureaus.
Bureaus. What did I say? Unions? Yeah.
So I think credit bureaus are a reflection of whatever happens in the traditional world. And they're supposed to be a third party, impartial reflection of someone's financial behavior, let's say credit behavior, right? Now, you can always debate how impartial they are, how partial they are, like, the types of things that get reported versus not reported, mistakes in that, so on and so forth. But the actual goal is to be an impartial third party view into someone's financial or credit behavior. And the centralizing part, and the second part of that is like, because they are centralized, like, can there be there have been hacks and information has been stolen, all of that stuff. On the hacks part, I may not know enough, but I've also seen hacks on the Bitcoin side where people have lost hundreds of millions of dollars. Or like on the crypto side, people have lost a lot of money just like that because someone got access to their accounts. And I don't know if it's comparable or it's a different type of hack. But security is an underlying issue in centralized and decentralized systems. To the second, or to the bigger point of like, can this be done on blockchain? I think other things will need to be, there need to be people who are willing to do or willing to conduct their life on chain. And then there will be a company that's going to be a reflection of that life, a third party impartial view into someone's life on chain. If the one main thing that the one main debate that I guess no one has the right answer to is like, if you allow people to have access to all of their data and you allow them to share their data by themselves, then you lose the impartialness in that sharing. You'll only share like your positive data points and not the negative ones. So I think a bureau will be a thing that will happen later, like not in very early cycle of on-chain. It'll come in like mid to late on-chain. And I've seen companies like building this type of stuff. They call themselves the credit bureau of the crypto economy. And they are asking people to, I think, submit their transactions or something like that, or like allow somehow, if people enroll into it, they'll track transactions and they'll try to be an impartial viewer. On the other side, if this consumer wants to get access to money on chain, then on the other side there is someone who can make their own decision and give money to the consumer for their transaction on chain, and this company can act as a middleman of impartial data about the consumers, and then can do all the work of like transferring the money, so on and so forth. So those things are feasible, but I think they're valuable if enough of someone's life is conducted on chain, and there need to be enough number of people.
Yeah. It's interesting. It also seems like the impact of a credit bureau on chain seems influential to where the money comes from. In your case, you put 340 million into an account and then you distribute that out accordingly. If it's on chain, it can be decentralized, meaning it can come in small. I could get $1,000 loan that could come from 1,000 different people or 20 different people. So people could have different like risk appetites for that, which might open up the market a little bit more, because I imagine lenders, traditionally centralized lenders, are going to be binary. It's like yes or no, you're approved or not. Whereas maybe there's people who want to take off more risk or less risk. It is kind of a fascinating concept though. When you think about this approval, it's like we're sort of, as a society, we're saying you are either worthy or not of getting money to do something. That something matters, whether it's education, building a house, or spending it on whatever you want, just getting money. But it is kind of an interesting, like, abstract concept of this mechanism to filter out who is worthy and who is not. I don't know.
Yeah, I guess there is no one, not a dictatorship. So I'd reframe it as like someone saying you're worthy or not. Is it's like we don't think that we can economically lend to you and come out on the other side positive. And obviously the person being declined doesn't feel good about it. They may feel negative because everyone's like, yes, I'll return money. Anyone who's borrowing money at the time they're borrowing, they're like, yes, we'll return the money. But as soon as they get the money, then they come up with reasons as to why they can't pay it back, because they got busy with something else, because they lost their job, and that may be a legit reason, but they spent money on something else. So the reasons immediately switch to being not being someone who's like not able to return the money. Anyways, like but it's like, I think it may be phrased as a third party saying you're worthy or not, but I think it's just the market economics that's saying whether we can effectively or economically give money to you for you to achieve your goals, where both parties end up winning.
Yeah. Let me ask about immigration for a second. In the U.S., immigration is a topic of conversation that's been in focus over the last few years, and I think even prior to that. And effectively, I think of the immigration policy as you have this membrane of a country that has borders, and it has to decide, like a cell in a body, it has to decide what we let in, who we let in, and who goes in and out. Right? That's the whole concept of the wall or the border. And to me, it seems like there's not a clear rationale on immigration policy, because it seems like we're kind of, we as in the U.S. society, are talking past each other a little bit. like there's two different points here. One is what amount of money do we want to invest into the integrity of the border itself, right? There's some people that will just cross that border, but you shouldn't say the expectation is 0 people per year come in illegally, right? There's some trade-offs there. So you could debate that, but then you also debate what's the influx of people that we want and what would be the criteria for determining who those people are that we want into the country. I think if you say you want nobody in the country, nobody coming in, then like the country's over. Then it just eventually, given long enough time horizon, kind of stalls out and dies. So I think the integrity of the borders is a less interesting conversation than the decision or the policy to figure out like how do you decide who comes in, and then how do you decide how many people come in? Do you have a perspective as to how far off the U.S. is? Like, are we in left field? Just are we totally off here, or do you see a pathway to making the immigration policies more sustainable and better, for lack of a better word?
Yeah, I guess all immigration policies can be improved. It's true for every country in the world. U.S. has particularly had good, not better immigration policies than other countries. The reason U.S. is, the reason U.S. is the most powerful, biggest country in the world, like highest GDP, is because it allowed a certain group of immigrants to immigrate to the U.S. U.S. is a land of immigrants, right? Like, and the policies are built around opening doors to the best quality people around the world, and over time it became a magnet for those folks. Now, can that process and can that system be improved? For sure. 100%. Like, no doubt that you can actually create better policies around attracting higher quality talent to the US and make their lives easier. Whether you want to put a number on it or not is a secondary thing.
What's the biggest process opportunity for improvement? Is it the documentation, like the actual paperwork in applying and getting accepted and visas and all that, or is it something else?
I think both fronts. If I were to pick one thing, I would remove caps in terms of how many people can immigrate to the U.S. As of now, for example, there are 85,000 per visa, H-1B visas per year that can be granted. Only 85,000, even if there are 500,000 people who meet the criteria of immigrating to the U.S. Or not immigrating, but it's a work visa. So even if 500,000 people are eligible for that, and then it becomes a lottery, right? But if you make it without a cap, or you increase the number of people who can move to the U.S. for work with this type of visa, you'll actually get a lot more quality people coming here. And people are willing to jump through as many hoops as you put in front of them because they really want to move. Yeah. Right? So you can obviously also make the process easier, but I think the simpler thing or faster thing could be caps. And, again, all of these things can have second, third order effects down the line. But these types of policies do need to be updated to make sure that the U.S. is constantly attracting the best talent out there that's going to build the next generation of the U.S. economy.
Yeah. Well, I point people to your Substack, Rohit, Mittal, Mittal.substack.com. You're active on Twitter at rohit.dot, Mittal. Anywhere else that you want to throw out there? You have the 2 sites, of course, at stilt.com and Onbo. Really enjoyed talking to you today, Rohit. I appreciate you sharing your time and sharing your perspectives, and congrats on everything you guys have built.
Thank you. Thank you for having me. And yeah, I enjoyed the conversation too. We talked about a lot of different things.
Yeah, I loved it. I
So
loved
that
it.
was, yeah, that was
All
fun.
right. Well, onward and upward, my man.
Yeah. Yeah,
Take
totally.
care.
Thanks for having me.
Bye.